Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/The Smattering, to get access to the 10 best stocks to buy right now. Insurance company Lemonade has had a pretty tough go of it as a public company. We've seen the stock price fall substantially as its growth has not generated the economic output that investors have necessarily wanted. Good news is it does have some cash. It has about $1 billion on the balance sheet. But the question for this money-losing business is that enough cash to make it? I'm Jason Hall. This is The Smattering. And I've got Jeff Santoro here with me to talk about Lemonade. Hey, Jeff.
Hey, Jason. This is an interesting one because whenever you see a company that burns cash like Lemonade does, you do have to take into consideration how long can that cash burn go before they really get into trouble. So we're going to take a look to see if Lemonade has enough cash to get through.
Okay, Jeff, let's take a look at its balance sheet, its cash on its balance sheet from its most recent reported financial period. And you see here about $1 billion, a little bit more than $1 billion. And this is a company that it's only been a few years ago since it went public, and it's raised substantial cash along the way with secondaries. But you can see here that cash has begun to deplete. And part of it's because it's a money loser on a GAAP basis. It's lost money every period since it went public, essentially. And also looking at cash flow, again, free cash flow, not always a perfect metric for an insurance company because cash from operations isn't the only way it makes money, but it's still really an important starting point. So you take cash from operations minus capital spending, and you can see free cash flow burn has continued to accelerate with Lemonade since it came public.
So Jason, is that cash loss generated mostly from the fact that despite having a really compelling story and despite being a disruptive force in the insurance industry, they're still not doing a great job at what they need to be doing, which is writing insurance really well? Is that what's causing the cash burn?
Yeah, I think that's a fair way to put it. We can share one more thing. This is from their most recent presentation. And you can see right here, this is not super big, but you can see at the top here in green, the growth numbers look great. In-force premium, this is actually premiums that are literally in force. That number increased 64% year over year. The total number of customers was up 27%, and the premium per customer grew 30%. So as they've added things, like they acquired Metromile and they've been expanding Lemonade Auto. So they've gotten into auto insurance, which is new for them over the past year. They stepped into homeowners insurance not all that long before that. And they've been slowly building that up on top of their existing renters and pet insurance business. So the growth is happening. So we see that. What's the issue? And the issue, Jeff, is frankly, it's exactly what you said right here. And that's the gross loss ratio is 89%. And you can see in prior quarters over the past year, it's steadily been close to 90% or even above for a company that says their target for the gross loss ratio is closer to 70%. I want to say what that number means. It's important. Basically, this is you take in those premiums for your revenue, you cover your costs, you cover losses. This is the gross amount of dollars that's left over. And there's not really much money left over.
So I know that they've been trying to branch out into all sorts of different types of insurance after starting with just one or two types when they were a younger company. Does adding more different types of insurance, like auto insurance and homeowners insurance and things like that, does that help? Should that help these numbers as they move forward? Is that the overall kind of business plan?
So the answer to that is it should. That's part of the idea here, and it gets a little bit to the kind of the Lemonade way, what they're trying to do, and they're using more artificial intelligence to do things like to do the underwriting to help make that insurance decision and to set the premiums. And I think that's a part of the business so far that hasn't worked out as management anticipated that it would. And that's why it's not as profitable as most insurers generally are in terms of on the underwriting itself. The AI is working great for things like the customer experience, being able to approve for insurance, making a decision really quickly. When somebody files a claim, getting that claim processed and approved within seconds in some cases, and getting the claim paid really quickly. All of that stuff's working. But the idea, again, is as it gathers more data and as it can educate its AI to start making better underwriting decisions with premiums that are more profitable. I want to give them a little bit of benefit of the doubt. We did go through a period where there were some more catastrophic losses with extreme weather on the Gulf Coast, hurricanes and that sort of thing, that we'll give them a little bit of a benefit of the doubt for that. But over time, as they add more insurance lines and they get more data, that we should see that number begin trending better. And it has improved, but it's still a long way from where it needs to be.
So with that $1 billion of cash on the balance sheet, looking at their average quarterly cash burn, what do you think? Is $1 billion enough? How long can they make that last?
So I think that the money should be sufficient for the business to last an extended period of time, multiple years, I would expect. But at the end of the day, an insurer, its economic value is going to be demonstrated in its ability to underwrite profitably. So I don't think we have a year or two before that we need to focus on the cash. So as much as we kind of use that as the premise for talking about it, I think it has plenty of cash to last, but investors need to see those metrics start to improve, because if they don't start to improve, frankly, Lemonade is going to have to blow some things up with the way they underwrite right now. And that could even lead to it being acquired by an insurer that knows how to insure, but is looking to acquire this really popular brand and the things they're using artificial intelligence for on the customer service side of the business that could make it an attractive acquisition. The problem with that is they're not going to be willing to pay a big premium for it, and it could come at further losses to investors. I think that's really important to remember.